up and the market panicked. So I'd like to offer you a different perspective of how this interest rate hike should or should not affect your real estate decisions. Welcome to Keeping It Real Estate. I'm your host, Milana, and I'm here to share my 21 years of experience and expertise with you. Yesterday, we received a second rate hike. Yesterday's rate change was 0.04%. In other words, the average 30-year fixed rate inched up from 3.54% to 3.58%, while the last 52-week low was at 2.83%. You know, I've been telling my clients rates can't remain historically low forever, and they should expect rates to go up late 2021 or early 2022. Think about it. In the early 1980s, interest rates were at 18%. By the early 1990s, they were hovering around 9%, which was considered to be the norm as it was close to that in the 1970s. People felt like they could breathe again. Here we are in 2020 complaining about rates inching up to 4%. Many of you probably remember the 2000s where rates were considered amazing and they were between 5 and 6%. And then we got into 2020 with rates becoming 2.5 to 3% on average. Can we process this? 3% interest is basically like free money. In other words, it costs you $3 for every 100 you borrow or 3 cents for every dollar you borrow. Effectively, interest rates are so important because it affects buyers' purchasing power and homeowners' refinance options, which, if advantageous, can allow homeowners to use equity to acquire more real estate by leveraging. What's interesting is buyers continue to pay more attention to price of properties and little attention to the cost of money. That's completely opposite what you need to do. Don't get stuck on price. Get stuck on payment. What's your monthly payment going to be? Spend more on price if you're comfortable with the payment. And if you know rates will continue to rise, which in my opinion they will, be willing to spend more today to secure the higher purchasing power you have with the lower interest rate today. I need to say this again. Spend more today to secure the higher purchasing power you have with lower interest rates today. I know, might sound backwards because when you focus on price, you focus on not overspending. Let me give you a clear example. Today versus tomorrow. Today, $1 million is at 3.5%, which is going to cost you $4,490. Tomorrow, $1 million will be at 4.5%, and it's going to cost you $5,065. This change is a 13% change in your monthly payment. Don't let distractions blur your focus from realizing your real estate goals. Interest rates affect you far more than purchase price. Purchase price over time can increase, it can fall, but as long as you don't sell during when prices fall, you can carry the property, meaning paying your mortgage payment, which is relied heavily on your interest rate. So lower rates will make it possible for you to carry through a down market. It will make it possible for you to pay your mortgage off faster, and it affects your daily output of cash in a far more impactful way than the property purchase price. So again, focus on interest rates, do not focus on price. If this was helpful, please comment, like, share, tag anybody you think would benefit from hearing from this. I will see you next week.